What's up, everybody? Welcome to the July 28th, 2025 IndiView Weekly Market Update. This is powered by IndiWealth, and I'm Jeremy Bryan. Today, we're just going to talk about what we see as the hot button issues and the topics that we think are most important for the coming week. So, without further ado, let's get going. So, let's talk about trade deals first. Trade deal between US and Europe happened over the weekend, and the market is responding with kind of a collective yawn right now. It is not substantially down, but it's not substantially up either. So, from the perspective of, we had talked about this about a month ago, is that I think trade deals now going forward are just less important than they were over the past few months, right? Is that April came along and we had that 20% correction based upon the tariff numbers that were significantly higher than anyone expected. And now we've had a subsequent aggressive rally back upward, and we're at all-time highs right now. And from that perspective, it was based upon, I think, well, there's a few things that it was based upon, but really, I think the component of saying, okay, that was the draconian element. We've backed off, we've adjusted, we've changed course. These are much more normalized trade deals, if you want to say, or at least not as bad as they were that when we thought in April. So from that perspective, we're okay and we can rally back. But I think the market has largely digested those now. And so from that perspective, it's going to be harder for trade deals to really make a ratcheting upward of the markets. I think the markets have digested that, moved on. I think the most likely scenario of a trade deal doing something would be more on the negative side, where if we, let's say US and Europe decided to break this off, and then all of a sudden we start tariffing each other upward and upward, or we do that with China, or we do that with whomever, I think that would have a negative ramification on the market. But even then, I think the markets would say, okay, we've seen this movie before. We'll see how long they're implemented, and how much of this is noise versus how much is actually going to go through. So even then, I think we're just in more of a collective yawn period for trade deals as far as their drivers of market performance in the future. One thing that I will be paying a lot of attention to is the job report. That comes out on Friday. And the jobs report, if you've ever heard me talk, I still think jobs and job sentiment are, if not the most critical, one of the most critical components of the US economy. It's a very simple premise in the effect of, if the US consumer has a job or feels like they can get a job if they need one, they will continue to spend money. And that's great backdrop for the US economy. So overall unemployment rates, I pay attention to it, but it's not the most important thing. The more important thing is job growth or job contraction. Job contraction, we have not been in for quite some time. It's not actually that common that we contract. We do contract from time to time. But really, I'm looking for what the trend looks like. And we've been in a bit of a slowing trend here recently. Now, does that slowing trend slow us down to an extent where we're just not going to grow as aggressively as before? Because again, if the consumer doesn't feel like they can get a job, that's when they start pulling back their spending. So I want to pay attention to the job growth trends. Are we stabilizing this slowing trend, or are we reaccelerating? Reaccelerating would be great as long as inflation doesn't get out of hand. But from that perspective, I don't see a great case for reacceleration at this point right now. I think stabilization is probably my most likely scenario, but I'll be watching to see if we're falling into more, let's call it contraction growth territory or decline. I don't see that as our case either. I think stabilization and a little bit slower growth is probably our base case scenario here. Turning to the chips, I want to talk about the semiconductors really quickly here, because Texas Instruments and Intel had difficult weeks last week. I think they were down more than 10% for the week for both of them. While companies like NVIDIA and Broadcom, which are AI-centric companies, they tend to benefit from the AI trends, while Texas Instruments and Intel don't benefit as much, or really not that much at all. And it's just become a complete differential. It is so different than it used to be. 5 years ago, these companies were, in that $100 to $200 billion market cap range, all kind of in that same boat. They were kind of considered peers in a similar fashion, and they still are peers from a business perspective, but from a market cap perspective, it is totally different now. AI has changed the game in semiconductors, where NVIDIA and Broadcom are the clear beneficiaries, and the market has dedicated them as clear winners. And frankly, their earnings have just been significantly better, to where NVIDIA is now the most valuable company in the world at over 4 trillion. Broadcom is over $1 trillion, while these other two companies, which again, if you went back 5 and especially 10 years ago, these were kind of the leaders, Texas Instruments and Intel. Texas Instruments is slightly bigger than it was before. I think it went from 120 to 170 billion in this 5 years. Intel's actually smaller, and Intel is the case of really when a company drops the ball and a company loses its technology lead, that can be very, very painful. And Intel's been dealing with that for 5+ years at this point right now. And based upon what I was hearing in their earnings report, I don't see a great case for them to get out of it anytime soon. So from an indie stock model, the only company we own here is NVIDIA. We do like Broadcom, but we don't own it at this valuation at this point right now. But from our perspective, we don't see a big change in the general trend of NVIDIA kind of leading the pack. If we ever get concerned by that, that would be something we'd revisit. But right now, we think it's still the best player in the game. Turning to earnings, the big dogs report this week. We've got 4 very substantial companies reporting this week, and Apple, Amazon, Microsoft, and Meta. So we'll know more about what the technology consumer landscape, and really, I think the most important is the AI trending. I'm going to do a quick mea culpa here in the effect of when DeepSeek news came out. I think that was in March, could have been in April. About DeepSeek was basically saying we can replicate the AI results with about 80% less cost going forward. I had made assertions at that time that maybe this spend train is over, that we're going to focus more on efficiency and usage of AI. Usage of AI is certainly getting some publicity, and use case scenarios are certainly going up. Where I was completely wrong was the spend maybe rationalizing or coming down. We have no instance of that at this point right now. It still seems every single dollar that these companies earn are getting pumped into the AI machine to try to increase their advantage over a longer period. We saw it a little bit last week with Google. Google came out and reported pretty good numbers, but they also talked about their CapEx numbers for what they're going to spend for AI generated, information and all that fun stuff and around their technology is actually increasing. So we're going to see if these 4 say the same thing. I don't think at this point right now we're going to hear anybody talk about cost cutting in this scenario at this point. The build seems to be continuing to go up, and that's where, and nobody frankly talks about DeepSeek anymore. So whatever happened there certainly was not a change in trend, and these companies continue to spend on their AI focused goals. Lastly, and a little bit of fun, I went on a bike ride this morning, so I wanted to talk about e-bikes. I am a fan. Now, I understand the negative scenario of e-bikes in the effect of I don't believe anybody should be going 30 miles an hour down a wooden trail where you have people and kids walking around, right? I get that. But from my perspective, I own an e-bike. I'm an e-bike owner. My wife is an e-bike owner. What I like about it is it allows you the ability to kind of change your ride. Some days you want to go hardcore and do the hardcore exercise and really go fast and do all that. You can put that thing at 0. So it has no assistance. And in that scenario, I actually get probably a better ride and a better workout than I did from a regular bike, just simply because at 0, that thing is a tank. I mean, my battery is large. Now I know they're getting lighter, but mine is not light by any stretch of the imagination. The regular bike I had before was significantly lighter. So you can get a pretty darn good workout on there. Just throw it at 0 and have a traditional bike workout. But what I like about it is some days like this morning, it was 70 degrees. It was sunny, a little bit of a breeze. It was a gorgeous day, and I just wanted to be out and enjoy the day. I didn't want to have an aggressive ride. So I could turn on a little bit of assistance. When I hit a hill, I can kind of take it, and I can go further than I would have before and probably still get a pretty decent level workout while enjoying myself a little bit more. So that's my case scenario for e-bikes, and understanding that, there are some negatives. There always are. But I'm a fan. I think I will never own a traditional bike again. I will always own an electric bike. And I would recommend them to anyone who wants to have that different level of experience. So that's my diatribe on e-bikes, and that's our hot button topics for the week. Tune in next week where we'll have our next hot button topics, and we'll see what happens then. Until then, thank you very much and take care.